Okay. Now for the early stage founders, this is probably the panel you've been waiting for. You don't want to hear some Canadian VC talk about VC. You want to hear from people based in the States where apparently the money flows like water. At least that's what every Canadian believes. So we're going to talk early stage funding with two people based in the States. So maybe let's just start. Can you guys both introduce yourselves, your funds, and what you invest in? I think that's the easiest way to start.
Hey everybody, my name is Jordan Wan. Grew up in Western Canada, now live in Denver, Colorado after 20 years in the Northeast in New York and Boston. I'm a solo capitalist. I'm a VC firm of one. I primarily focus on pre-seed and seed investing, like to lead, co-lead, check sizes $750K to $1.5 million. I think that one thing you learn in venture is that there's always a bigger fish. So the small funds are always looking up at the big funds and trying to figure out where's their white space. And as a result of that, a lot of the markets I look at are vertical software, complex industries, where I think more patience, more research, more prior mind is an advantage for a smaller fund. And so we skew a lot to very thesis-driven founders, oftentimes founders who spent a lot of time in industry, came out of pain, and decided to build a solution that they always wish they had. So,
just before we get Gaurav, 2 more questions. What's your fund size so people understand?
30 million, actually fresh powder. So looking to write checks. We're very concentrated. We've done about 45 investments over the last 6 years. So I do about 5 to 7 deals a year. Very hands-on, sort of pre-board board member. And so as a result of that, lower velocity, but higher conviction.
And last question, what's your ties to Canada, if any?
Went to high school in Saskatoon. My dad did his PhD here at Western, lived in Edmonton, Vancouver, almost went to Waterloo, did a lot of the math contests, all that kind of stuff growing up, but ended up getting sucked into the draws of the United States. So.
Thanks. Gaurav, you want to introduce yourself in the fund?
I didn't realize this panel was branded as VCs from the US because that's a security risk these days. Before you guys throw any eggs at us, like I am Canadian first and you are Canadian and I carry my Canadian passport very,
Mine just expired, but yeah, probably should renew that.
Exactly. So Canadian first, very much. I think I'm actually a pretty typical Canadian story. Was born in India. Family moved to Canada when I was in high school. Finished high school here. Went to University of Waterloo for software engineering. I'm sure there's some Waterloo folks here. Many in the Bay Area too, where I live now. Started a company coming out of Waterloo that was in the mobile space. That brought me to the Android team. In the early days, helped scale that platform. And the last kind of 13 odd years, I've been doing early stage venture. Was at a fund called Founder Collective for 4.5 years. Was lucky to be a seed investor in Skip the Dishes. Back in the day, based in, of all places, Winnipeg. The rule was only summer board meetings in Winnipeg. The winter board meetings were not in Winnipeg. So when people ask me like what's it like to be on a board of a company in Winnipeg, so I don't know, it was beautiful. Every time I went there, it was gorgeous. I don't know what people talk about. But anyway, did a bunch of Canadian investments and then spun out to start a fund called A4 Capital. We're a pre-seed fund, so we're investing super early stage, idea stage, sometimes even pre-idea, and have founders come work at our offices as we iterate through a bunch of different ideas. We feel like we should brand ourselves as Pivot as a service because we help founders find different, run through different ideas until they find something and then they're off to the races. So anyway, to give you a sense of the fact that we go in very early, I think it's going to stop working. But I can probably talk loud enough that you guys can know this back. So anyway, we go in super early, investing out of Fund 4. Which is a $185 million fund. We've raised about $500 million across 4 funds since we started. Typical check could be anywhere from $500K to $2 million plus US. What else would you want to know?
I think that's good. We'll ask more questions now. And just to clarify, I think if you hear a dollar amount here, just assume it's American. As much as we're all Canadian, we know that the American dollar is the one that everyone in North America talks about. So why, you guys both look at Canada. Why look at the Canadian market? I thought everything happens in the Valley in New York. So why even bother looking at Canadian companies?
I can kick it off. It's funny when I used to be at Founder Collective, I first started bringing Canadian startups to the partnership. for us to invest in. And I would get teased all the time. People like, well, where's Canada again? Like just making fun of the Canadian ecosystem because there weren't many success stories to point to, right? If you think about it historically in tech and venture, maybe Nortel, though, of course, they didn't last for too long. And then RIM and obviously that, wasn't the best eventual story. So, there weren't many venture-backed startups to point to. But for me, from a first principles perspective, I really thought this ecosystem had a lot of potential because there's a lot of talent, right? There's a lot of, especially technical talent, given, we're investing primarily in technology companies, that is gritty, that moves fast. They have the skills. They're humble. There were still many gaps in terms of taking that talent and building a company around it, which is where I think the ecosystem has come a long way in the 10 plus years I've been investing. But there were some really amazing opportunities. I brought in Skip the Dishes into the partnership. We did that and we had a pretty good outcome pretty quickly in that company. And since then, I've probably invested in over a dozen companies, everywhere from Vancouver to Halifax and a bunch of stuff in Toronto. So I've always just gravitated towards, when you're investing early, just amazing talent. And I think that's very much here.
I would just add to that I think for me, there is a diversity of sectors and geographies and perspectives, and I think oftentimes when you start to look outside of New York City and Bay Area, you just meet some really exceptional entrepreneurs that oftentimes have a very different perspective of the world. And so I think as a pre-seed fund, particularly, you really want to figure out what your advantages are. And I think as a smaller fund, non-consensus kind of investment is the default style of investment, which means that you sort of have to go out of your way to go against the herd. And so if everyone in Silicon Valley is building one type of horizontal software, then there's probably not a whole lot of alpha to be generated as a manager. And so for us as VCs, we are looking for outliers. We're looking for non-consensus thinking. And for me, I think having grown up in the Canadian, education system and just having such amount of respect for the technical talent, the industry talent here, it's a no-brainer, particularly given that there's also a lot of, if I understand, a lot of grants and non-dilutive funding that also kind of stretches the dollar. And so I think that's very attractive. And lastly, venture is also has become very much a media game. And I think a lot of, founders get kind of lost in the filter. And so if you're willing to do the work as a VC to kind of go to places where people aren't there and bring capital to areas that are underfunded, I think that's where really the advantages are. So for me, I know I kind of went full circle, grew up in Canada, just did my first investment in Canada last year, and I'd like to do a lot more here.
So you got two VCs living in the U.S., both invested in Canadian startups. So let's get to the question everyone here without financing wants to know is what's the best way to find more people like you, to approach you, and what's the mistakes you see Canadian founder do that an American one wouldn't when they're pitching a fund?
Well, I'll tell you the mistake I used to see 10 years ago. I see it far less now. I could literally tell you right by looking at the pitch deck in the first few slides if it was a Canadian company or an American company. And the reason being, in the Canadian company usually starts off with how they'll exit the company and make the investors money. Versus the American company, they never talk about that. It's all about, we're going to be the next Facebook or Uber, or pick your favorite analogy. And I understand where the founders were coming from, because from a first principles perspective, the idea is to make money. And it's okay, I can make you 3x, 5x, 10x, whatever it is. But in a weird way, as VCs, we don't want to think about returns when we're making investments, because it is ultimately a power law. And you want to believe that if this works, it'll be far bigger than anything you and I can imagine. Right? So the fact that we can imagine how big this will be is kind of a problem, right? Which again, it sounds a little bit weird when I say it. Understanding that most things don't work out. I think the panelist earlier was talking about how his angel portfolio, 90% of stuff hasn't worked out, which is very much par for the course. But the 10% that works out has to work out really, really big. And I think the related point is sometimes I find Canadian founders are, if I find the right word, maybe a little too humble, too conservative, not thinking big enough. And I see where they're coming from, because I was a founder myself. I understand sometimes it feels uncomfortable to be like, this is going to be a $10, $100 billion company when you don't have a single dollar of revenue. And there's 15 competitors and all the things that are not working. But somehow you have to be able to balance this on the ground execution, but also like thinking big and being able to tell that story to investors, to future recruits. And I've seen the ecosystem come a long way. Part of it is probably because of podcasts and all this content that's available to anybody anywhere in the world, which is, I think, helping everybody get up leveled and not just folks that are in Silicon Valley. But I'd say that's probably one of the biggest things. And I tell founders of companies that are in Canada that we've invested in, like, don't think of yourself as a Canadian founder. You just happen to be in Canada. And there's a bunch of advantage of being in Canada, shred credits and so on and so forth, access to talent, but you are competing at a global level. Like when I look at you, I don't think of, oh, there's alpha in Canada, or like I have a quota for Canadian founders. I have to invest in the best founders globally. And frankly, I and other people have a negative bias of the fact that you're in Canada. So you have to punch way above, what a Silicon Valley founder would say in the story they tell, because you have a bit of a handicap, right? Because of the ecosystem, and we can unpack if you're interested in why I believe there's a bit of a handicap. But I think if you think of yourself as like at the same level as everybody else, and you speak the same language and vernacular, there is no reason you shouldn't be able to raise from American investors, or frankly, the best capital in the world. One thing I'll say that has changed is I think investors are a lot more open to Canadian, like Series A, Series B, than wasn't the case before. One of the biggest challenges we had doing seed investments in Canadian companies is like, will Series A investors come into these companies after? I think that has very much changed and gone away thanks to many companies over the last 10 years. So I feel like you're at the same kind of, you have the same, opportunities, frankly, that any other founder does in Silicon Valley.
I want to get to the ecosystem in a second, but Jordan, any thoughts here? What
Yeah.
mistakes you see from Canadians?
I would just add that, at least for me, I read every cold email because every VC, when you've been in the industry long enough, you'll have an anti-portfolio company, and then you're gonna like search in your inbox, like, did I see this? And you're gonna find like at some point one of them was right in front of you, and you just never took the meeting. And so it kind of drives this insecurity of always wanting to make sure you see everything. And so I look at every cold email, every cold LinkedIn message, but like every other VC, I probably spend about 6 seconds on it, right? And so if it doesn't immediately hit the point that I'm trying to understand, and this is where I think ecosystem evolution and having the alumni effect of successful startups really pays dividends, is to be successful at getting attention from VCs, you do need to know what's important to them, and more importantly, what's not. And so if you lead with sort of subscale, revenue metrics or a product demo or a bunch of slides about how you're going to do it, you're not really giving me that 6 seconds where I really care about, like, what is that one unique thesis about the market, or what is that one thing that you believe in that you think everybody else has wrong. And so that is the messaging and the positioning. And so a lot of founders sort of think that nobody's opening up my emails, no one's reading my stuff. And the reality is it may not be a deliverability problem. It might be a messaging problem of how you're actually explaining what it is that you do and how you think about the markets that you're going after. So that would be the only thing I would add, and something that I see a lot is just really bad emails like, hey, like, oh, do you invest in this? And then I'm like, okay, that's not a very helpful email. What do you actually do? So, yeah.
So I'm going to go a bit off script. I love an example of like a great email that came into your inbox, or a great introduction that you said, shit, I have to call this founder, even though it was cold. If you can think of one offhand.
Yeah, for me personally, I think that I try to avoid the sort of riffraff of the layer one ideas like marketplaces. I'm sorry if any of you are building this, but like, talent marketplaces, mentoring platforms, like things where there's like 50 of them every year for the last like 20 decades. And so anytime someone's doing something really interesting where I don't even know what industry they are, then I instantly just want to learn more. And so I look for, and then I look at their background, and I look at like, do they have observability in their background such that the journey to starting the business is both like very organic and it's completely irrational, right? So irrational meaning there's a bunch of other things they could be doing. They could be making a lot of money doing something else, but they choose to go build this business. Or the organic part is oftentimes now you see a lot of multidisciplinary founders that combine a whole bunch of different fields of study or work to go build the business they want to build. And so that always gravitates, for me.
If I could just quickly add, I also read all my cold emails, but I will say that it's not the best way to reach an investor. I bet you all of you are no more than 1 or 2 degrees away from a founder who's raised from an American VC, if that is your goal. And if you can, you should try to get a warm introduction, somebody who can ideally vouch for you, who's worked with you. And I'll tell you, like, at least my experience, when I get warm intros from a portfolio founder, I will spend 10 to 20x more time than I do on a cold email reading that email, right? Because for every warm intro I get, I probably get 20 to 30 times more cold email, right? So, and there's just a lot of noise, frankly, in a lot of the cold email. So while it can work and you should try, if obviously you don't have any other way to get in front of investors, I just think you're doing yourself a disservice by sending cold emails.
I agree with that. And also just to add to that, I think the bigger principle there is like referenceability. And so a lot of like particularly younger founders or founders who kind of haven't really done anything in the startup ecosystem went directly into entrepreneurship really struggle with this. It's just like you look at the profile, there's no mutual connections, and it's just really hard to develop that threshold level of confidence that this is a good 30-minute meeting that you're going to spend, And so I think to the degree that you can warm it up and make it really freaking obvious for the investor you're reaching out to that like through a proxy of trust or through a proxy of reference, this is a warm intro or this is someone that knows me, that knows you. I think those are always helpful as well.
Just quick follow-up question. You guys both said you read your cold emails. Can you give an idea of how many inbound roughly you have a year and how many investments you write? So like just what odds are getting through? Just because I think founders hear it, but they don't hear it. So like,
So across the team, and we have about 6.5 investors now.
half?
Well, because the one person does product launches as well for us, including investing. So she's like half her time on investing. But we look at 6,000 companies a year, and that's a mix of warm intros and cold outreach, right? So I'm not including all the cold inbound we get because we don't track it, frankly. I probably get, I've never counted, at least 25 to 50 pitches a day in cold email, right? Probably even more. And that's probably the case across all my colleagues. So there's a lot of inbound and there's a lot of warm stuff. So again, we have to prioritize given, no matter how hard I work, I still have 24 hours in a day. There's only that many founders I can meet. I wish I could meet more. I have to prioritize warm intros. And even within warm intros, it's like, whether it's from an intro from a founder who I have a lot of respect for, who says, I know this person really well. And like, you've got to take this meeting. Like those are the ones that just bubble up. Right. That is just because I also have to spend time with the portfolio, with fundraising, with being at events like this. There's just a lot to do. So again, you want to figure out how do you increase your odds of getting that first meeting. And then of course, in the first meeting, you want to be able to figure out how to get to the second meeting and so on and so forth. It's a funnel. It's not too dissimilar to enterprise sales. Right. And think of fundraising as just another enterprise sales motion.
So you said 6,000 inbounds are warm. How many checks do you write a year on average?
We're doing like 15 to 20.
Okay, so 50 to 20. So you're saying that's 1 in 300 to 1 in 120.
Yeah, it's like 0.3% conversion or something.
How about you, Jordan? The number's different?
It's probably the same. The thing is like you see so much, like a lot of times I don't even count it when someone sends you like all the analysts and associates at the large firms will send like list blasts of like 50 companies on a list. Like I don't even count that, but yeah, and then now with the bots, you get like sort of the auto-generated and I don't understand because you would think that those emails would get better, but they're actually worse because they all look the same and none of them have any relevant information, and so yeah, it's about the same.
And if you are going to send a cold email or frankly even warm email, like make sure you, at least for us, because we're investing so early, it's really about you we're investing in. So really kind of surface why you. Right? Who are you and why is this your opportunity? I feel like a lot of companies focus on the idea. And I understand where you're coming from because you're like, the idea is what we should talk about. And we will eventually. But like for me, it's we're searching for talent, right? Ideas are everywhere. They're a dime a dozen. As I said, pivot as a service, companies pivot. Like, sure, we'll talk about the idea, but what I really want to know is, are you the one and why? I think you've got to like start with that.
And I think this is, for me, the thing that gets me good is a good memo. I am more of an ideas first kind of investor, and everybody has their different styles, right? For me, I think the thesis or the idea is oftentimes revealing of the founder. And so I have a hard time actually like deciphering good to great in terms of talent. In fact, I'm very cynical of repeat founders or self-proclaimed like 3 times, 4 times serial entrepreneurs. I care just about what is your like one brilliant idea or unique insight. And so if you send me like a deck or a thesis that's written out with your ideas, then I'm actually more likely to read a bit. And then if I find it interesting, read more of it. Whereas I think a lot of times you get so much like generic, email that looks all the same, and it's hard to really parse through.
Cool. I'm gonna go back to the Canadian ecosystem. Gaurav, you mentioned that sometimes you're worried about the Canadian ecosystem and the influence it has on the founder. So what is that? Tell us what you're worried about.
Yeah, look, the talent density in places like San Francisco is just so high, right? Because everybody there is a builder, and these days builder in AI. So what happens is there's events like this literally twice a day that you could be attending every day. Like I sometimes joke, I'm like, San Francisco doesn't have a tech week because every week is tech week, right? And what that does is if you're an AI founder, you go to some of these events, you start to like meet people that then invite you to private dinners, which is really where like business happens. These events are great for top of the funnel, just like finding interesting people, but really the really interesting stuff is happening offline. That is happening at a scale that is unparalleled anywhere else. And what that allows you to do a few things. One, get your early customers, right? As a startup, 0 to 1 is like, I think the hardest stage, right? Getting somebody to believe in what you're doing, give you a shot, ideally write you a check as a customer, even more than as an investor. That's hard. And I think you have an unfair advantage in places like San Francisco. Of course, there's some disadvantages too, where there's like a lot of like sort of, group thinking or whatever. I get all of that stuff as well. So you have to be able to balance it out. I think in places like Canada, I was just talking to a portfolio founder earlier today. He's like, for me, early sales is just emailing, right? I'm emailing companies, whether in San Francisco, New York, use my product. We just talked about cold emails are not very effective, right? Especially these days with all AI SDRs. So in places like San Francisco, it's like human to human connection. Ironic, I'm saying that in a world of AI, but human to human connection versus here, you're doing everything remotely. So my recommendation, even if you're building a company here, is to go spend time out there with customers if they're in San Francisco or wherever they are. Just you've got to, I think in person stands out way more, especially in this world where everything is getting so more and more automated. And some ecosystems just give you an unfair advantage.
Any thoughts here, Jordan? Because you're based in Colorado, so yeah.
The question is more about
Like, is there anything again, you've made one investment here, anything you worry about? Let's say anything outside the Bay Area in New York, what's the disadvantage for a founder being in a non-prime ecosystem?
Well, I think there's a speed that the tier one markets do impose on everybody, and I think it's a very electric energy when you go to San Francisco or New York, and you kind of just see that teams are always comparing notes, investors are comparing notes, and so there's this natural energy. The thing you worry about, and I worry about that too, with the Colorado and greater kind of Mountain West market, is that you have to find, because ultimately a startup is about growing incredibly fast. Yes, the funding helps. Yes, the investor may sometimes help, but ultimately it's driven by the founder. And so where do you find individuals who naturally are born with that, eighth gear, ninth gear? And I think that a lot of times people move to those areas and they develop those gears through kind of just mixing and matching with other people around them. But in second tier markets, I think what's really hard is finding those people, and also avoiding adverse selection. Because the question I always ask is, if they're so driven, why didn't they move to the Bay Area? But that's like not a fair question in honesty, because I think there are really good personal reasons, and me personally live in Colorado. So I think the thing you do worry about is the revealing preferences of the individuals, and like, do they have they surrounded themselves with the type of network that's going to really push them to grow as quickly as possible.
So I would love to hear from your perspective, because I think one place actually can has a disadvantage of thinking what's big and what's fast. So when you say something growing really fast or really big, I'd love to hear what you mean. Again, to a certain extent, you answered, Gaurav answered saying so big I can't imagine, but like what's fast and what's big?
Actually, just maybe to answer that question slightly differently too, I think one misnomer about pre-seed is, I think in Canada, I notice a lot, founders lead with traction metrics, like how much revenue we have. And for pre-seed, it's actually every startup is a binary outcome. And actually, the inversion here is not to think about like the path towards the outcome, but how quickly could you validate or invalidate the thing you're doing as early as possible? Because quite frankly, we're all wasting time if 4 years later, after raising $1 million, you finally figure out that the business actually doesn't work. Like, I'd much rather the company figure that out in 2 months, right? And so because we're all going for binary outcomes, and that's what you're signing up for when you raise venture capital, the question for me is more around like, what do we have to believe in or know to believe that we should continue to run this startup next month because it's going to be a big business. And so it really kind of front loads all the experimentation, all the core questions, and then actually traction becomes like one of those things. But in pre-seed, typically traction is usually not the right metric to index on if you're an investor or a venture capitalist or as a founder.
I think one thing I'll just quickly add, this is still early days, but we're seeing that the way AI companies are getting built from a traction perspective is changing. So historically, what we would see is pre-seed meant you had quit your job, you've done a bunch of customer validation, maybe you had an MVP, no revenue, but you kind of know the direction you want to run. That's when you raise your first round of funding, $1 million, $2 million. You build out the product, get into market, get some revenue, maybe a few 100,000, maybe $1 million, you raise a Series A. That was kind of the typical journey. These is what we're finding is that companies initially are slow because they're still iterating and through a bunch of ideas. To Jordan's point, is there finding market pull. But once they do, they grow really fast. And that bar for what that fast is going higher and higher. For example, in our portfolio, we did this analysis. We found that our AI native portfolio relative to our pre-AI native portfolio, let's say ChatGPT moment as being sort of that demarcation line, that AI native portfolio is getting to $1 million ARR twice as fast and by burning 1/5 the capital than the pre-AI companies do, right? So they're building product faster thanks to code gen tools and so on and so forth. They're doing it in a more cost-effective manner, but also there's just a lot of market pull once it starts to work, right? And some companies take a little bit longer to find that they're there. Some companies do it a little faster. And now we have more profitable companies in our portfolio than we ever did. I mean, for the longest time, I had 0 profitable companies in the portfolio. Companies would go public and they're still unprofitable. And these days, companies raise a few $1 million and they get to profitability. Again, not every company, but more than I've ever seen before. And I think that trend may continue. And the reality is the bar for the next round of funding, because of that, is going higher, right? The revenue multiples may not be changing, but the amount of revenue these companies have by the time they raise these Series A's and B's, it's just a higher watermark. Does that continue or not? I don't know, but that's what we're seeing today.
Yeah. And just to give you an idea, I think this is also really important. For VCs that have been lucky enough to be part of a unicorn, it really raises the bar on everything else you see. I was lucky enough to be a pre-seed or seed investor in 2 companies, one that went from 0 to 300 million in basically 3 years. They raised a very large round by Sequoia last year. That was sort of a prosumer consumer startup. And so that kind of path makes sense given that you have lower friction, large TAM, and a very efficient way to manufacture growth. The other unicorn that I backed went from 0 to about 90 million in, probably 3-4 years as well. But it's an enterprise software business. And so both obviously grew very fast. One is 3x the other, but they're probably, in my mind, just as good as each other because the context matters a lot too. And so I think in general, you are trading off larger accounts, smaller accounts, SMB, prosumer, and there's an implicit level of belief that there's more switching costs or there's more entrenchment. And so I think a lot of the traction metrics can sometimes be a red herring as well. So a company that grows super fast from 0 to 1 million or 0 to 2 million, you may take the opposite bet as a VC and just say hey, don't think that's sustainable, or think that, there's a really strong wedge, but we don't think there's a lot of defensibility. And so that's why I just don't love the revenue metric story so much, because I think in early days, it just never really matters. It's all about, I think for me, ultimately the thesis that the founder has.
Cool. I want to open it to Slido. Marie, do you have some questions? And also, there's a lot of good questions in Slido. So what I'm going to tell the team, and Marie doesn't notice, next week we're going to go through all the questions we didn't answer and get answers and put in our newsletter. Okay, Marie? She's not paying attention, so she just, I think, committed to that.
No, I'm committed. I'm committed to anything you say, Alex. Let's go. So, 33 questions. Okay. Let's go to 3:00. Oh, you guys haven't started for this panel. Oh, question for Jordan. What key points do you look for in a memo that has turned into a successful investment?
I think the most important things for me in the memo is, the most important thing is for me to believe that you believe in something that no one else believes and you are ultimately correct. And so if you have a unique insight about a market And, for me, I don't love automation software because I just think we're at a point in the curve now where jamming more software is no longer like that disruptive. And so I love ideas that fundamentally reimagine the world, like reimagine the world in a different way. So, for example, just to give you a very concrete example, I led the pre-seed round of a business earlier this year doing US prior authorization. So prior authorization is when you kind of get prior authorization for your procedure from the healthcare payer. And this company basically said, don't think this should exist. Like, why are we even doing that? Like, what we really should do is just examine in real time the clinical performance and decisions that clinicians are making through time. And if they're making good decisions, then why are we doing prior authorization? And so their whole approach to the market is to say that we are going to get rid of prior authorization. Whereas every other business out there is fundamentally trying to automate the administrative workflow of paper pushing. And so for me, that was a powerful narrative and powerful insight. And it's indicative of the fact that the founders spent a lot of time in the business in healthcare to develop that viewpoint. So for me, that's a great memo, is when I look at the world differently after reading it.
All right. Canadian incorporation versus Delaware corporation as a Canadian company and from a US perspective, US VC perspective.
I mean, personally, I'm ambivalent. We've done both. I do, from what I'm not a lawyer, but my understanding is if you're Canadian incorporated, easier to get shred credits and some of the grants and stuff. So free money is better than dilutive money. So I tell companies, if that's what you want to do, that's fine. I don't think there used to be a tax implication for us as US investors investing in Canadian entities. I don't think that exists anymore. I want to say when we invested in Skip, it was a Canadian entity and we exited that and that was totally fine. So Canadian is just fine.
I'll jump in here because I've seen it with a lot of my pre-seed companies. Certain American firms will want you to be a Delaware and flip to Delaware just because they're thinking about themselves and their LPs, because there's a QSBS. So if you invest in a company under 50 million valuation, you hold it for 5 years, they can get out cap gains. Look, if you make a big outcome, it's nice, but not important.
I think if all else is equal, just go straight to the U.S. Just like it just makes things a little bit easier if you plan to expand to the U.S. and you plan to raise money in the U.S. at some point. I don't think logistically it's probably that different. But I will say a great investment opportunity like throws all the hairs off the deal. Like it just doesn't matter. Like if you want to invest, and you'll figure out how to make it work.
One more question, maybe?
Yeah. Tell us a little bit about market size. It's come up a couple of times. Like, what's a good market size to invest in? Do you have a number?
Infinity?
I'm assuming the question is for TAM for the companies that are getting built,
Correct.
right?
Yeah.
Look, I personally don't even look at that slide too much. As long as there's a billion something in there, like that's fine. And the reason is, like, if you look at the Uber seed pitch deck, which is publicly available, and I know because my previous fund, we had invested in the seed round of Uber, the TAM, the founder said was $4.2 billion, right? And founders always exaggerate the TAM, so you always have to discount that. The company today does 10x that TAM in revenue, right? I.e., even the founders couldn't imagine what the real TAM was and how big it was. It wasn't like they were trying to be conservative. It's not like they thought the TAM was 40 billion, but let's say 4 billion because it's more believable. No, they genuinely thought that's how big the market was. So that's why I to Jordan's point, it's a binary outcome, right? We're not going to get the market sizing wrong. If this company doesn't work out, it's because we just couldn't execute and the market opportunity was there. Or if we get it right, the TAM that we thought we were starting off with was way too small because we found adjacencies, we expanded, the market expanded. A whole bunch of things go right in the best companies. And that's why it's like good to understand the market size. But frankly, I wouldn't get too caught up on that.
Yeah, just to add to that, I think TAM is definitely one of those like layer 2 things that happens in the process. If the investor's asking you about TAM in the first call, I think it's kind of it's kind of a cop out. I definitely do it, to be clear. I'm like, oh, what's the TAM? Like, all right, pass, too small. But I will say 2 things about TAM. One is I find it useful to work with the founder during my diligence process to see if we can analyze the TAM as a proxy to working with them and seeing how they think. So the act of working through TAM is a helpful exercise. The second thing is I, prior to starting the venture fund, was a founder and operator, and I actually started one of the larger East Coast-based go-to-market strategy firms. So all I did was help startups go to market and help them scale. the one thing I learned about TAM is that most founders look at TAM from a top-down basis and not from a bottom-up basis. They multiply by like end users by like some unit economic value to get to their TAM. But really, what you should be thinking about is also like how many accounts are there that you can sell. If you're doing B2B sales, is it mid-market, is it SMB? What is the ACV of those values and how hard is it? So one of the biggest kind of bad combinations I try to avoid is small, medium-sized business, very low ACV, very hard to sell. I mean, that's just not a good market, period, forgetting about TAM. And so there's a lot of nuance here. And I think what's more important is to demonstrate that you have thought very deeply, intentionally about how you're going to go to market, who you're going to sell to, and made some rough estimates on that market so that the investor can get comfortable with the fact that you've done your homework. I mean, it's all about the revealing kind of indications of exceptionalness, right?
Cool. I think that's the questions we'll take for now. I have one question for you guys. I know you want a warm introduction, but if someone wants to reach out to you, is there a best way to reach out to you?
I'm very easy to find. Just my first name, Gaurav, Gaurav at a4.vc, or LinkedIn or Twitter. I'm GJ on Twitter. So fairly easy to find. But again, I strongly recommend a warm intro, mostly because it helps me learn about you a little bit more before I meet you. But either way, please send a cold email if you reference that we met here today. Makes it easier.
For me, just LinkedIn. I use that probably more. So just add me on LinkedIn or send me a message.
Cool. Can I get a round of applause? Thanks, guys.